Very good morning, folks. At the outset, I must thank Divya Jyoti Foundation, Registered Valuer RVO, for this wonderful program organized for 2 days as a CEP program covering various facets of valuation, including valuation standards. And today's topic is going to be very unique, different, and the scope of valuers is going to open up a lot. That is the topic that has been suggested to me. I must at the outset thank the entire team at Divya Jyoti Foundation RVO for giving this wonderful opportunity to me to share my thoughts on today's topic. And what is today's topic? It is IVS 2020, valuation of non-financial liabilities. Just give me a minute time. I will share my screen. Yes. So how do I do it? Yeah. Very good morning once again, friends. On behalf of Divya Jyoti Foundation and on my personal behalf, it's a pleasure actually to share my thoughts on the latest and new standard IVS 2020 on non-financial liabilities. I understand the majority of the participants, more than 70 of them are here right now. All of you are from various facets of the valuation profession, including the valuation of land and building as well as plant and machinery. And this particular standard is applicable for both the type of valuers, both land and building as well as plant and machinery. Why? Because there are, with respect to certain contracts, construction contracts, where there is a possibility of non-financial liabilities, and there will be a requirement for the land and building valuer to do the valuation under this. So before I venture into this topic, I have to first give a very brief backdrop how this particular subject is relevant and how the entire subject will unfold and give the opportunity and scope to all of us with respect to this topic. And the moment the word finance is there, there is always a taboo that, okay, the plant and machinery valuer will always feel, okay, it is not for me. A land and building valuer also will feel that it is not for me. So that is why it is non-finance. So therefore, let us be very clear that, guys, this standard is going to actually, of course, some concepts of finance may be required to actually appreciate this subject, but it is fundamentally the plant and machinery valuers and land and building valuers only have to actually will have a lot of role, major role to play with respect to valuation of non-financial liabilities. Good. Now I want to first start with this standard IVS 2020. You will not find in IVS 2017. IVS 2020 is the standard introduced for the first time in IVS 2020, which is applicable from 31st of January 2020. And one request to all the participants, don't use your chat box. Unless and otherwise I prompt you to use the chat box, don't use your chat box. And when the session is going on, the entire participants' attention should be only on the session and only on the facilitator. And in case you wish to actually raise a question, that question alone you please type in chat box. Maybe when time permits, I'll actually go and find out what is the question you have actually typed. And your chat box should not be the medium to actually register your attendance. Please desist from typing. And you have the respective the facilitators. We have the two facilitators who are online. You have their the mobile number. You can directly WhatsApp to them or SMS to them. Don't use this chat box. It will be a divergence for both the participant as well as for the faculty. Good. Now, coming to the topic per se. This topic is very, very important and interesting. For one reason, this is a new topic. Second, this topic will be applicable for every company. I repeat, every company. Now, why I'm mentioning this particular point? First of all, we need to understand this particular topic, non-financial liability, has two very important aspects. One is liability. We have been all through these years with called as a myth, a misconception that valuer means we should only value asset. No, wrong. Valuers should also value liabilities. And liability valuation is very, very important and interesting for one reason, because these are payables. And these payables have to be actually quantified. Some of the payables which will already be quantified are called financial liabilities. Borrowings. I have borrowed 120 crores plus interest. Payable 120 plus 48, 168 crores. This is payable to Bank of Maharashtra. This is financial liability. This is payable to Edelweiss, non-banking finance companies. That is a financial liability. Financial liability is amount that has been borrowed, that has to be paid. Finance. Financing activities means borrowing activities and lending activities. Both are finance activities. Borrowing activities and lending activities. As far as financial liability is concerned, payable. Money that has been borrowed, that has to be paid. But here it is non-financial liabilities. So we will understand what is first meaning as non-financial liabilities, and then only we will go into this particular subject. And I have made this point very clear to all of you guys. Subbarao Garu, don't type anything on the chat box. If you have been late, please excuse me. I don't want anybody to type in the chat box. Okay.
Sir, we made this for the attendance purpose.
No. Let them type it directly to you in your what is it, SMS, or this is not the professional way of typing. All of them are highly educated. Let them directly type you in your SMS or in your WhatsApp, not in chat box. Don't use chat box for recording your attendance. Right. Now, first very important point. In this standard, there are three terms that is used. Number one, may, must, and should. And these three words will actually drive, I repeat, these three words will actually drive how a valuer has to actually take the prescription, mandatory prescription or an optional prescription. So therefore, when I take you into this particular subject, at that particular time, the word must, the word should, the word may will actually guide you. Okay, this is actually not mandated. So therefore, an optional or an alternative, I can use it in my process of my evaluation. But the word must Means you don't have any other choice. Unconditional responsibility. But there is a very interesting word called should. This may or must, I can actually distinguish. May means I will consider, I will even drop also. Okay, like for example, will you consider my love? I am loving you. Okay, I will consider it or I will drop it. So that is what the youngsters will do when a love proposal is made. That is may. It is not must that the other person has to compulsorily love the other person. But there is only a consideration. But must is an unconditional responsibility, guys. So whenever the way may is used in the standard, the valuer will consider the prescription. He can even drop the consideration, saying that the reason number one, I considered it, but it is infeasible, so dropped it. Reason number two, I considered it, but the fee is infeasible, so dropped it. So that is how he can conclude it in his report. But must is he has to follow. But as a English teacher, if you ask any English teacher, teacher, give me the difference between must and should. The teacher will say, okay, must and should seems to be very, very close synonym word. You can alternate it in your English sentence. But in international valuation standards, must and should both are different. Must is the request made by your wife, and should is a request made by your mother. Both ladies are they actually guide you in your life. They actually steer you in your life. But mother will say, go to a market and buy lady's finger. So you go to market and you find lady's finger is not fresh. So what do? We actually see an alternative. Look at this blue color, alternative, and whatever fresh vegetables are there, in lieu of lady's finger, we buy that, and then we will actually give it to our mother, saying that Amma, lady's finger was not fresh, so alternative I tried. So this is good, please do it. But if wife is saying go and buy lady's finger, we have to find what is, there is no second choice, no unconditional responsibility. Must fulfill responsibilities. So please be very clear about this word must and should. In should, alternatives you have to do. It is not that you will not say no, I will not buy lady's finger at all. Ma shabd to final hai, but you have that option. But here option is not there. So must and should, please be careful. Now, before I take you to 220, we have actually 120 sections, actually called as 12 sections. I say 12 sections. But out of this 12 sections, before I take you, I want to make one announcement or information very important to all of you. Because slowly I will introduce you what is called as non-financial liabilities, and then types, methods, approaches, methods, what are the various arithmetic methods. One by one, I'll give example. And maybe if time permits, I'll also try to solve some examples also in this non-financial liability valuation. Okay, good. Now, I want to make one point very important to all of you guys. Please look at this, Google. Let me show you one. This is sustainability reporting. The sustainability reporting is going to become sustainability reporting. Look at this. ITC is also coming out with sustainability reporting. Look at this. ITC is coming out with sustainability reporting, and sustainability reporting is going to become the norms of the day. And sustainability reporting in India, look at this. Nearly 47 companies have disclosed their sustainability performance. Now, what is this? This is the first question. Now, please remember this triple bottom line. This is called triple bottom. All of you, please understand this triple bottom. Look at this, guys. This is called triple bottom line. What is this? People, planet, profit. Understand this, guys. And look at this chart. Look at this. People, planet, profit is called sustainability. Only reporting, I repeat, reporting only on profit has become thing of the past. You need to actually report also profit, also about people, also about planet. That means environmental reporting must, social reporting must, financial reporting. Now, this is where maybe accountants are very good in recording transactions. That too, what you call it as, you can record transactions with respect to the financial transaction. Non-financial transactions, social reporting, you have actually given 17 crores for social development. You have, and Infosys has spent 300 crores this year, 1920, exclusively for social upliftment purpose, social development. Now, I want to ask one question. What is the change that has been made with respect to this change development? And there are companies, ONGC, oil and natural gas companies, they have funded with respect to environmental protection and wildlife protection. They have spent close to 60 crores. Please read their annual report. Now, what is the change? Why they should do all this? And this is where my good friends, valuers who are land and building valuers, plant and machinery valuers, they will come into the foray. And these are the 6 laws, Indian laws on environment protection and wildlife Act. What is that? Environment Protection Act 1986, Forest Conservation Act 1980, Wildlife Protection Act 1972, Water Prevention and Control of Pollution Act 1974, Air Prevention and Control of Pollution Act 1981, and Indian Forest Act 1927. And I want to make this point very clear. Please look at this. The Indian environmental laws require a fundamental shift, like an independent regulator. Who has made this point? Our Honorable Union Minister Prakash Davadekar. And this is the draft. Repeat, guys, this is an 83-page document. This is a Ministry of Forest, Environment, Forest and Climatic Change. Recently in March 2020, they have given this draft notification. Please go through this. This is a notification that is going to actually totally revamp the entire environmental laws. Now, why I'm making this point, there are many companies, especially electricity companies, energy companies, they have been charged by pollution control boards with notices where the probability of penalizing them will run to not in thousands or lakhs, but in crores, not in few crores, not in tens of crores, not in hundreds of crores, but in thousands of crores. That is a kind of environmental damage they have made. Now, liability. I'm slowly coming to that word, liability. Now, I have created empire, I have done turnover, I have done profits at the cost of whom? At the cost of environment. If you have costed environment, you have been polluting the environment. I repeat, you have been polluting the environment. You have been emitting the CO2, the carbon monoxide. Then what is the fun in actually making a turnover and profits? And you mean to say chartered accountants, cost accountants, company secretaries, MBA finance from the big institution will be the right people to do the valuation of non-financial liabilities? Absolutely wrong. Who can do the valuation? Plant and machinery valuation with an understanding in the respective domain expertise. The effluent has been actually dumped in the land. Effluent has been dumped in the what you call as rivers. And what is the kind of damages they have made to the land? And we are all part of this ecosystem, part of this Mother Earth, and industries by polluting the Mother Earth, making turnover, making profit is useless because they cannot sustain. They cannot sustain. And I want you to, all of you, I am sure all of you would have come across the 17 UN Sustainability Development Goals. Please look at this US Sustainability Development Goals, because this is the UN Sustainability Development Goals. And based on the sustainability development goals in our country, Niti Aayog, I repeat, Niti Aayog, they have brought out SDG index. I repeat, SDG index. Please look at the top 12 states of India. Kerala is number 1. And who's the bottommost 5 states? Bihar, Jharkhand, Arunachal Pradesh, Meghalaya, Yusum. Top 5 union territories. Top 12 states. Kerala 60, Himachal Pradesh 69. Because they are all interested in developing this 17 UN sustainable development goals, and the respective state government is also supporting. Whichever state which is green, whichever state which is against polluting the environment, they are actually in number 1. So where is Telangana? 5th rank. Where is Tamil Nadu? 5th rank. So where is actually Goa? Goa is also there. Where is Delhi? Delhi is not there. The bottommost 5 states. Maybe Delhi is in some other state. Look at the Uttar Pradesh. Uttar Pradesh is not there here at all. So UP is in the bottommost 5 states. Very, very pathetic. So please understand, the future is actually not only making profits. The future is with respect to concern about social and environment, and that carries 2/3. I repeat, that carries 2/3. Now I'm coming to liability. Now, when I'm speaking about these things, there are liabilities with respect to non-finance. And these liabilities have to be measured. And I want to make one particular point to all of you guys. Ind AS, either IAS 37 or Ind AS 37. This is IAS 37 or Ind AS 37. Ind AS 37 also speaks about the provisions. I repeat the word. The word is called provisions, contingent liabilities and contingent asset. You know, there is a discussion that went on 5 years back in 2015 itself to remove the word contingent liability, and instead of that, they want to put a term called non-financial liability. Already the discussion is there going on. They don't want to put a word called contingent liability. And please look at this is Ind AS 37. Provisions, contingent liabilities and contingent assets. Now here, valuation they have been mentioning. And I want to make one point very clear to all of you guys, that with respect to valuation of non-financial liabilities, otherwise called contingent liabilities, okay, that has to be measured and reported in the financial statement. Now, who will measure it? In Ind AS, all the valuers must come together this particular time. And I'm mentioning this point very seriously. Why? Because in the new valuers bill, there is no mention about Ind AS, Indian Accounting Standard, where lot of scope is there, very big work is there with respect to valuation. Ind AS 16, property, plant and equipment. Whom you mean to say who is going to value the property, plant and equipment? Componentization of the equipment. Aircraft consists of components, and each component will have a different life. Different life. So therefore, remaining useful life will be different. And you mean to say who will be the eligible person to do the valuation? And the Ind AS very clearly says, it is not the historical cost, it is the fair value. It is the fair value of that asset has to be booked in the accounts. And you need to say who will be the right person to do the valuation. The particular standard says management's best estimate. I repeat the word, management's best estimate. Now, who is management? Why none of the valuer are actually raising up and saying to the government by giving a recommendation in Ind AS, the word management best estimator, they must ensure that they must bring a separate government notification, government order stating that management must engage a registered valuer in case the management feels the valuation of the asset will be beyond 50 lakhs, will be beyond 1 crore. Why not? So therefore, the scope of the registered valuer will expand. The point is, the RVOs are not, they have to think, very important. I am also addressing to the Divya Jyoti Foundation as an RVO. And also, I understand there are many participants who are from the other RVOs also. The RVOs must think. I know who is the think tank of RVOs. It is not RVO. It is the valuers. As valuers, you are the participants. Without you, there is no RVO. Please understand. you must actually guide, direct, instruct the RVOs. Yes, you are an RVO. What you are doing, you have to actually create the route scope for valuers with respect to wherever the word management has been put. How management will be the best guy to do the valuation when you are there. You are qualified, you have the authority from the IBBI to do the valuation. You have to actually make drive, and RVOs also have to drive parallelly. Valuers have to drive, RVOs also have to drive, stating that, and through that IBBI you should drive very clearly. IBBI will not do anything. They will only pass a notification. They only pass a government order. They only pass a GO. You should make the IBBI to pass the GO, and that is there in your hands. Lot of work is there, and presently who is doing this work? Management themselves is doing. How management is doing? Management will engage a consultant, and who is that consultant? I will not tell. You know better. So there RVs have to come. Just imagine 50,000 companies are there in our country, public limited companies. 5,000 listed companies are there. 5,000 listed companies. How many registered valuers are there as of today? Only 3,000. Okay, only 3,000. Each of us can get one public limited company, listed companies valuation. Why not the registered valuers? Why not the RVOs are thinking in that direction? Please think. You will understand. As and when I go para by para, as I unravel the mystery of non-financial liabilities valuation, you will understand the gold mine 220, it is there. None of us we know that this is a gold mine. People think it is a land mine. Oh, no. Non-financial liability, finance is there. It is not my work. Wrong. You are absolutely wrong. Let me take you one by one inside. Now, these are all the sections. Section 10, 20. 10 and 20 alone will take a minimum 20 to 30 minutes for me. Then basis, valuation approaches and methods. Of course, basis and valuation approaches and methods in IVS 104 itself, basis have been discussed. But anyhow, I will remind you with what are all those defined bases in IVS and undefined bases, non-defined bases in IVS. I will mention that what are all the valuation approaches and methods. All of you are already thorough with, but I will refresh your memory with respect to the non-financial liability. And of course, what is the mathematics, the method that is prescribed? One is called the top-down approach, another is called the bottom-up approach. Market approach is top-down approach. Income approach is bottom-up approach. So these are the two major approaches, and I will be explaining the steps also. Maybe I'll take a mechanism, an arithmetic also I'll try to demonstrate if time permits. And what are all the special considerations for valuation of non-financial liabilities, discount rate for non-financial liabilities, how do you estimate the cash flows, the probability, risk margin, all this we'll try to see one by one. So these are all the 12 sections, and under each section you have the various paras. First point, this section 10 is an overview. So you have only two paragraphs, 10.1 and 10.2. 10.1 says the principles contained in this general standard apply to valuation of non-financial liabilities also. What is general standard? IVS 101, 102, 103, 104, 105. 101 is scope, 102 is investigation and compliances, 103 is reporting, 104 is basis, 105 is actually valuation approaches and methods. Those 5 is equally applicable for this. So along with that 5, you must also read at 220 and valuation with the non-financial liability component. This standard can have additional requirement in addition to the general standards. Now, with regard to determination of discount rate, directly has come to that, and risk margin. In IVS 105, valuation approach and method, BAM, conflict with 220. Okay, when there is a prescription given in 105, there is a conflict with respect to 220, because in 220, they speak about the determination of discount rates in section 90. Please look at the section 90. So there are places where both the standards may differ in their prescription. Then valuers must apply the principles prescribed in 90 and 100 only in this particular standard, not the prescription given in 105. So that is also they have given that conflict. Even two standards. It is not that there is a double standard, but that particular 105, the context is different. In 220, the context is with respect to non-financial liabilities. Okay, so that is with respect to the generic point. Now come to what is NFL. What is NFL? So for purpose of 220, NFL are defined as those liabilities requiring non-cash performance obligation. Non-cash performance obligation. Please look at this. Now what is called as non-cash performance obligation? Now there is a concept called LD in contract. What is LD in contract? Liquidation damages. Okay. So late fee, it is equivalent to a late fee. So LD, there are some damages that will be subtracted. Okay. So late damages, we can even call it as, or liquidated damages in short. So for late delivery of the contract. Now what is this actually? If the contract is 800 crores and you have to deliver the contract in 18 months, please look at this. Deliver the contract in 18 months. And you are delivering it only on the 20th month. Or you are communicating that this, you are only delayed, I have delayed, he has delayed, she has delayed the delivery of that day. All those things you do it, 18 becomes 20 months, 2 months delayed. As the time gets delayed, there will be a formula in the contract. There is a formula in the contract that is called non-cash performance obligation. Now, that formula they will multiply 800 crores minus 12%. So 12 8s are 96 crores. My God, 12%. Okay, 2%. Let us take 2% itself. In 800 crores, even if they deduct 2%, it is 16 crores. It is 16 crores, guys. So 800 minus 16 crores will be subtracted. Balance 784 only will be paid. There will be arbitration for it. Now, this 16 crore, how they arrived at? Value non-cash performance obligation. So, you have a lot of scope here. And in your books of accounts, their books of accounts, how 16 arrived, your books of accounts, how you are going to accept. Okay, you are accepting LD, but you are not accepting 16. You are accepting only 4. You are not accepting 12. So how 4 has been arrived? Valuer. LD. What is India is 115? Please look at this. What is performance obligation? What is non-cash performance obligation? Okay, please look at this. Here you don't pay anything. But there is another interesting point in non-cash performance obligation, which also involves GST also for this. For that 16 crores, GST is applicable because it is a service given by the government. For example, you are a government contractor, government has given you a contract. 800 crores is the contract. 16 crores they have subtracted. 16 crores is the service government has given to you in, what do you say, keeping silence and accepting what is called tolerating. That is the correct word. Tolerating your delay in handing over the possession, in handing over the contract. The tolerance, okay, the tolerance. Many people, they actually speak about non-tolerance in our country. For tolerance of this delay, there is a charge that is called liquidated damages. Now, how do you arrive at it? There's a calculation. There is a mathematics. Now, do both the parties will agree for it? And in books of accounts, how do you put it? So, books of accounts is accounting part. Valuation part is first. In India, they make one terminology very clear. Identification of the liability. Second, measurement. Third is only recognition in books of accounts. Fourth is only disclosure. Identification, measurement, recognition, disclosure. IMRD. I and M, who will do? Valuer has to do. I repeat, guys, measurement, who has to do? Valuer has to do. And look at India is 115. Performance obligation is a promise to deliver a goods or a service or a series of distinct goods or services that are substantially the same and that are the same pattern or transfer to the customer. Look at this is an illustrative list. The standard itself has given. The standard itself has given the illustrative list. This is a non-exhaustive list. This is only an example. Okay. And you can go on. Look at this deferred revenue. Now today we are in COVID-19 pandemic. And already the government through Atmanirbhar Bharat Abhiyan, through Atmanirbhar Bharat Abhiyan, the economic stimulus package, the announcement has been made with respect to all the government contracts. I repeat, all the government contracts by default, 6 months will be extended. So therefore, LD may not be applicable. But your revenue is delayed. Your revenue is delayed, guys. Your revenue, you have submitted a bill and that bill gets delayed. Your bill has to be paid, but the payment date gets delayed. Because the payment date gets delayed, there are liabilities. What are the liabilities? Deferred revenue. You have a cost. There is an interest element, implied interest, because you have invested money. You have to pay interest to your banker. Who will pay that? So therefore, there is a deferred revenue has a cost. That is a liability. That is called non-finance liability. That is a non-finance liability. Warranties. Because each one, if I explain, it will take minimum 15-20 minutes. One or two, I'll explain. Environmental liabilities. What is warranty? Every year you have been selling automobiles, two-wheelers, four-wheelers, air conditioners, refrigerators. Okay, all these durable items you actually sell. Okay, now when you sell this, you actually give warranty. You say 2-year warranty, you say 3-year warranty, you have extended warranty. Extended warranty, separate charges. All this business Jamela will be there. No. Once you are given a warranty, out of 100 customers, not all 100 will return back, come back and say, no, I want to claim my warranty. Out of 100, first year 5 may come. Second year 15 may come. Third year 25 may come. So 5 plus 15, 20, 20 plus 25, 45. 55 will not come. So, and second, when 5 is coming for the first year, the cost will be very less because the product will be new. When you are coming for the second year, probability is also there that the first year who has come with the replacement, he can again repeat for the second year also, but the probability will be very less. Third year, 3 years you are given warranty. So what is the past year's obligation, how you have done it, you extend it for your every year's sales, and then do the multiplication, arrive at the number, arrive at the cost. I repeat, the cost, not the selling price. You actually replace a component. Take an old component, replace with a new component. What is the valuation for it? The valuation, you will take the market price, you will take the market value. No, you will take the fair value. You will take the cost. You will take the cost as of today. Cost of today you will take. So that you have to do the valuation. Valuation as on 31st March. Valuation as on 1st of January. Valuation as of 31st of December. That you have to take. Very interesting. It is not non-financial liability requires business understanding. I repeat, no business understanding. He is not a valuer at all. He has to actually quit and do some other work. Understanding business is very, 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 very important. How business is done, how manufacturing is done, how sales is done, how marketing is done, how customer will come back. All this must be understood. A lot of study has to be done. So warranty claim, today who does warranty claim? Who does that the warranty claim provision in books of accounts? You take any of the two-wheeler, four-wheeler, refrigerator company, AC company, Voltas Limited you take. Please download the Voltas Limited's balance sheet and then see provision for warranty. Who values it? Who values it? Management values it. And what is the value of the provision for warranty? It will be 120 crores. 120 crores valuation work. 120 crores valuation work. Imagine the fees for it. I am just giving one company's name. Just imagine. So how that arithmetic is done? The management will do that arithmetic. Management itself will give to the auditor. Auditor will actually check this arithmetic and then do it. But today, the valuer's job is very important. And the recognition has been brought in valuer's bill also. But they have missed out Ind AS. So Ind AS should be brought in and saying that yes, all these calculations, registered valuer also should be there. Now you know why in valuer's bill Ind AS is not brought in? Because number of valuers is very less in our country. How many valuers are there? 3,000. How many companies are there? 5,000. How many work will be there? Each company, there will be minimum work for 10 to 20 valuation work will be there. every environmental liability, warranty claim, asset retirement obligation, property, plant and equipment. So every work is very big work. Today valuers are not there. How many plant and machinery valuers are there? Hardly less than 1,000. How many SFA valuers are there? Only 1,000. You mean to say with this number, Ind AS can be included in valuers bill? No. How many valuers are required in our country? 2 lakh valuers are required. 2 lakh valuers. How many are there? Only 3,000. You must actually tell all of them, come. We need more valuers. Go and write examination. How many of them we actually encourage? We think that by encouraging them, they become our competitor. We are absolutely wrong. We are absolutely wrong. That much work is there. Can you do all the work? If the company gives you 20, 30, 40 work, can you do? It is not possible. Even the standard says the companies, registered valuers and valuation rules 2017, very clearly in their annexure 1 model code of conduct, they say a valuer shall not take too many assignments. What is too many? What is too many? It all depends upon the kind of work you take. The kind of work you take. 120 crore valuation. If I take 10 such size, you mean to say my office will be, I'll be happy with it? I cannot be happy. One work itself will take me minimum 5 days, 10 days, 15 days to do a valuation for 100 or 120 crore. So because that much of data you have to collect, you have to understand, you have to put that in your valuation report. First version, second version, third version. Then only that quality will come. Then only that reliability will come. Then only that reliance will come. Then only that reasonableness will come. It is not an arithmetic. You are not a calculator. You are a valuer. So therefore, lot of inputs have to go inside. So valuation of warranty claim, provision created in books of accounts is so significant. And I want to add one more point. In 2016, we are in 2020. In 2016, please refer to one case law. This is actually a High Court decision where provision made in the books of accounts with respect to warranty claim is an eligible deductible expenditure in income tax. Please understand. So that means the valuation what you do that will be accounted in books of account. Second, there is also an eligible expenditure. Eligible. First time a provision is allowed as an actual expenditure in books of accounts in income tax calculation. Please go through that particular High Court decision. The grounds are evolving. So that is the need of this non-financial liability, guys. So that much significance is there. It is actually a gold mine. People have not touched it. And I must tell all the RVOs, you must actually focus your attention on the technical content. You must actually give a lot of technical, what do you call it as guidance, technical guide, background material, and a lot of workshops and virtual labs have to be conducted. RVOs have to continuously enable the registered valuers up to date. And every item, deferred revenue, there is a need for a separate booklet. Warranty, separate booklet required. Environmental liabilities, my God, environmental liabilities. Let us take chemical plants. There is a place called in Gujarat, Ankleshwar. I don't know how many of you are know about that particular place. We have 81 participants online now. Ankleshwar is a place in Gujarat. And before, and Gujarat, when you are going from one ended from, what is that place, from Bombay or whatever other place, you are going to Ahmedabad or Vadodara or Surat, whatever place. We have to actually cross that place, Ankleshwar. Ankleshwar is a place full of factories. I repeat, full of factories. And what factories? All chemical factories. All chemical factories. And what is the kind of the ppm property, the pollution particle per million? That is too much content there. And when the car is driving that particular place, you'll actually say, Bayaji, you just put your, you raise your window because it will be too much of pollutant. And for the people who live here, they are actually used to it. But for new people, they may get giddiness. Chakra jayega. Environmental obligation, environmental liabilities. Today, how many is government is concerned about the environmental liabilities? That is why this this particular section, this particular point I have mentioned it to be amended soon. Union Ministry of Environment, Forest and Climate Change. This is very important, guys. In this lockdown, guys, all the factories are shut down. The entire globe is actually rejuvenating. Very good. Very good. So just imagine if we confine ourselves to the norms and we don't damage the environment, we are leaving this mother earth for our next generation for them to actually breathe properly. So therefore, these environmental liabilities today, laws are there. What you have this, look at this, Water Pollution Act is there, Air Pollution Act is there, which puts a lot of levy, penalty on the companies which pollutes. Today, majority of the companies to whom the notices have been given are all government companies. Where the notices are there, they have gone for a application against the tribunal in the respective board itself, and the case is pending there. Now, come to valuation. In the books of accounts, there will be a mention. That there was a notice, and notice has been responded, and the case is pending before tribunal. Is that sufficient? Standard says no. What is the impact? What is the obligation? What is the measurement? What is the liability? Whether that particular case will be favorable or unfavorable? You have to say that. You cannot say that no, it is not possible. I can't say. What are the steps you have taken? How many days the cases have been fought? What is the argument? Favor, against? The particular probability that the case is going in what direction? Now, what is the maximum liability? What is the minimum liability? That has to mention. Who can say this? Who can say this? Once you measure this only, then it has to be either we have to average it or weighted average it, or we need to actually take minimum itself. We need to actually book in the books of account. For example, the case is actually going out of our hands. Then you have to measure this and recognize in books of accounts, say that this is my liability, and tell this to the shareholders. There is an environmental liability and we have recognized as a liability, we have to pay this. Anytime the case can be against us, so we have to pay this much. So we have to inform the shareholders. It is shareholders' money. The environmental obligation. So now, so much list is there. I am now taking you one by one. So this is with respect to the introduction part. Although certain contingent consideration liabilities may require non-cash performance, such liabilities are not included within the scope of IVS 220. Now, what is this? Although certain contingent consideration liabilities may require non-cash performance obligation, such liabilities are not included within the scope. So, as you go in the next few paragraphs, you will understand what are the exceptions in IVS 220. So, let us go inside this. Now, with respect to profit margin in liability. Now, how do you actually value this? Will you value this at cost? For example, warranty. For example, tire is warranty is given. Tire warranty is given. Engine warranty is given. Gearbox warranty is given. Axles warranty is given. Okay. Spark plug warranty is given. So like that, warranty is given for some parts. Now, for example, the warranty is given for gearbox. Warranty is given for axles. Okay, front axle, back, rear axle. It's given. Now, there is a what do you call it as people come forward and say, okay, axle has been not good. Of course, generally axles, gearbox, and all people may not come. But I'm just taking one simple example to understand that in case there is a warranty claim with respect to the products that has been given warranty. What is the rate at which you know the number? You know the number. So you have sold 10,000. The warranty claim will come for 58 numbers. The 58 numbers you will multiply with what? The cost or the market price? This is the question. The standard makes it very clear. The party assuming a non-financial liability typically requires a profit margin. So in case I sell this as a spare part, I'm going to get margin. Or if I put that as part of my main component or main product, that also I'm going to fetch margin. Either I sell it as a component, as a spare part, I'm going to get margin. or I install it as part of or fit it as part of the main component. There also I'm going to make margin by selling that at a selling price. So therefore, do the valuation including profit margin. This is the prescription. Please look at this. So on the fulfillment effort and risk bond. So therefore, the party assuming a non-fair typically requires a profit margin fulfillment effort to compensate for the effort incurred risk bond for the delivery of goods. So therefore, you have to include a profit margin also while valuing the non-financial liability, because in normal sense, if there is no warranty claim, you are going to sell that with the profit margin only. So therefore, that is the value of that particular that component which you are going to replace it, because there is another argument also for this. Just because you are replacing that particular component free of cost, the profit which you are supposed to earn, you are not earning, which becomes an opportunity cost. I repeat, which becomes an opportunity cost. So therefore, guys, we need to actually. I'll just take a 5-minute break. Just a 5-minute break. Have a hot. I'll just have some hot coffee, and then I will resume back. Just 5 minutes break. Okay. Good.
Hello everyone. In the meantime, can we have all the cameras on so that we can take a group picture by the time Gopal Krishnan sir resumes? Still few cameras are closed. May I request everyone to please open the camera and we can have a group picture. We will start again. Let's page one. Let's page two. Thank you. We will just resume at 11. We have closed the chat box, but attendance for the people who have typed down, we have taken that. Even people can text me privately, or if they have texted in the WhatsApp group, it's also fine. We will open the chat option at 11:40 so that everyone can write their questions.
Okay. So now, asset liability symmetry. Generally, there is a feel. Yeah. So thank you very much for being patient for the few minutes. There is a feel that if liability has to be valued, liability is money brought inside. So there should be an asset always for a liability. But for a non-financial liability, that asset liability symmetry may never be there. Not necessarily it should be there. For example, you borrow money. You borrow money, for example, a term loan. A term loan is say 40 crores. For 40 crores, you will have a machinery, you will have a land, you will have a building, you will have some assets will be there. So there will be asset liability symmetry you can see. But with respect to a non-financial liability, like for example, environmental obligation. For environmental, what asset will be there? Just because you have polluted the environment, you are supposed to pay that penalty, that obligation. Similarly, liquidated damages. Where will you have the equivalent asset for it? Similarly, your power purchase agreements, your deferred revenue with respect to the cost with respect to deferred revenue. Where will you see? You cannot see that. So that is why it's very special. Okay. So that financial liability, you will have that asset liability symmetry. Non-financial liability, you will never have. So therefore, you will have a challenge. From where will you start? Sometimes if you have the financial and asset and liability matching is there, you will take the asset cost and then match that to the liability. Oh, that is the amount you have to pay. You have created a building worth 73 crores. So therefore, 73 crores should be the liability. The liability cannot exceed the asset cost. Like that you can conclude. But here you cannot do that. So therefore, you have to be very careful. It's very special. And the method of arriving at that valuation is also very different, very unique. Good. So non-financial liability will most often be valued using a liability framework only, no asset. So that is why this is a special standard. And we always use non-IBS base also. What is the IBS base? You have IBS base, for example, market value, market rent, liquidation value, synergistic value. These are all IBS base value. But what is the non-IBS base value? Fair rent, fair value. Then fair market value, fair value and fair market value. Market value is different, fair value is different, fair market value is different. Entire Income Tax Act, they use only a term called fair market value. And market value we use in the market approach. Fair value we use in financial reporting, Ind AS, that we use. Good. So the valuer must, please understand where the must is there. The valuer must assess the value would affect asset liability symmetry, and valuer must understand and follow the regulation, case law, guidance related to that basis. So what base you will take? Please wait. Let me take you into the approaches and methods. Another 5 more minutes, we'll go into the approaches and methods. So generally, asset liability symmetry, valuer should reconcile to a corresponding asset will be rare. Why reasons? Non-financial liability often do not have recorded corresponding asset, already discussed. The corresponding asset of a non-financial liability may be held by numerous parties, for which it is impractical to identify and reconcile the asset values. For example, liquidated damages. How do you do it? So, will you do the valuation? Will he accept? His LD, will you accept? It is very, very critical. And sometimes it will be in arbitration. So, how do you do it? So, these are all challenges. And despite these challenges, only valuer's role is very critical. And I'll tell you, in deciding the liquidated damages, your valuation report sometimes will be taken by the arbitrator as a basis, as an indication to arrive at or to propose or to propound that particular decision or the verdict in the arbitration. So these are all very critical aspects. The market for NFA and NFL is often highly illiquid, thus resulting in asymmetric information, high bid-ask spread, asset liability symmetry. You cannot normally adopt any others, what you call comparable companies. Normally in market approach, you will have comparable company. You can take that, do the discounting, do the premium, all those you can do, that adjustments you can do. But here, it is highly illiquid. Comparables are not comparable at all. It is totally asymmetric. So you cannot take the comparables at all. It's very difficult. You have to develop your own mechanism. That is where lot of thought process, work, and one NFL valuation, doing one building land and building valuation. Whatever fees you have been charging for land and building valuation, 5x you can charge. 5x you can charge for one NFL valuation, because lot of thought process, lot of brain work, lot of data collections, lot of reasoning you have to do. So one NFL valuation is enough for, instead of doing 1 month work, doing 5 work in 5 months, do 1 work in 5 months, enough. The fees is same. Look beyond. Very important. Look at may and should. Participants most often transact in the subject non-financial liability may not be the comparable company. That's what I said. When competitors holding the subject non-financial liability, they may not divulge information. So how do I get the data? So third-party warranty insurers, the value should consider if a market or participants exist outside the intermediate industry. This is where the difficulty, and the comparables are very difficult to take. So you have to appoint your own people, go to the market, give some questionnaires, do the over the phone talk. You need to actually do a lot of specialization work in this. Doing an environmental obligation, environmental liability calculation. What is the spread of damage they have made? What is the law prescribes? Legally, what is the liability? Is there any prescription in the law? There is no prescription. That is the worst part of it. You read the environmental laws, the law will say minimum what you say penalty, maximum penalty. In between, they'll put one number. If you question this to the pollution board, they themselves may not know. They will see this side, this side. Why? No, I have the right to put penalty. 1 crore to 10 crore I can put. I put 5 crore. Where is 5 crore? From where you got it? That is why valuer's job is. Your valuation report will guide the pollution control board to actually arrive at the. They will actually say, oh, this much is the. They would have put a penalty for 10 crores, but the actual damage will be only 1.5 crores. Or the expenses which you will incur to remove the damage and recoup it and bring it back to the original green, you will only spend 1.5 crores, but he is putting a penalty of 10 crores. There you will say, when you have to bring back the originality itself, cost is 1.5 crores. Where is the question of 10 crores? That is where the law can be even be subtle, and it will actually be it will come to the normalcy by looking at the valuer's report. Oh, correct. I think there is a message in valuer's report. So you actually give thought even to the legal luminaries. So very important, guys. Why NFL valuation? Okay. Para 20.9 says, NFL valuations are performed for a variety of purpose. Look at this. First is financial reporting. I already told you, India is. Second, tax reporting. Okay. And third, litigation. I already showed environmental laws. They have put penalty. Fourth, valuers sometimes asked to value non-financial items as part of general consulting, collateral lending, transactional support engagement. Example, there is a very big resource that has been identified, and there is a 200 feet or 300 feet, 500 feet drilling has to be done, and I have to excavate. So I will actually be polluting that particular environment. Now, before I enter into an agreement, I must know what is the extent of pollution that will happen, what is the cost that will incur to actually rejuvenate it, bring it back to the original shape or original greenery. What is the cost involved, and what is the time involved? What is the cost time value involved in it? All this you have to factor it and arrive at. So then there will be a valid mechanism to enter into an agreement with the respective government or with the respective party who's actually going to implement that particular project. So that is what it's called transactional support engagement. So all these are happening nowadays, but valuers' role has not been understood. But corporates understand. And today there is no law, there is no mandate under any law that the registered valuers, respect to plant and machinery valuers, land and building valuers, have to be actually engaged with respect to this work. Good. Now, what are the bases? The valuer must select the appropriate basis when valuing non-financial liability. So what are all the bases available? You have the market value. You have the synergistic value. You have what is called as a liquidation value. These are all some of the bases. So I'll just share with you this one more point. So So this is your IVS 2020. So guys, look at this. Sorry. So maybe I'll share this properly. Please look at this, guys. So this is your the various bases. This is IVS 104. And what are the defined bases? Please look at this, guys. These are your defined bases. So market value, market trend, equitable value, investment value, synergistic value, and liquidation value. Now, whether this will be useful, please wait. We are going inside the subject now. And what are all the other non-defined values? Fair value, fair market value, and these are the only two things. And this is only non-exhaustive. So list can be still more also. Going concern value. This is not discussed in IVS at all. That is going concern value will come here. Going concern value is another value. The company, how do you value a startup company? Startup company is considered to be a going concern only. So therefore, going concern value is actually a base. But IVS doesn't prescribe that as a base at all. So you can bring that going concern value as a other basis of value. Good. So let me now take you to the next one. Good. So these are all the reasons for your NFL valuation. Now, basis over. So other non-financial liability valuations are performed using basis of value defined by entities other than IVS. That's what I said. Going concern value, you can do it. Okay. Some examples of which are mentioned in IVS 104. What is not there, you can define. And valuers are the right person to actually come out with various bases. Sometimes for NFL, bases which is not there in 104, you can design a base. You can devise a base. For warranties, you need to arrive at a unique base. You cannot take those bases because will you arrive at the cost? Will you arrive at, will you take the market value? Will you take the cost or will you take the market or will you take the fair value? So sometimes cost can also be treated as a fair value. For example, cost price, your actual cost can also be treated as a fair value. Not necessarily market value should be a fair value. There has always been a dilemma that fair value means is it market value or cost price? Fair value can be a market price in circumstances. Sometimes if market is not at all there, your cost price itself can be treated as a fair price. So fair value. So that is where you have to actually define your base and come out with a reasonable base with respect to NFL valuation. The valuer must understand and follow the regulation, case law, interpretive guidance related to those bases of values as a valuation date. Good. Now, what are all the approaches and methods available? So the same three approaches, cost approach, market approach, and income approach is available, can be applied for valuing non-financial liabilities. The methods described above may exhibit elements of more than one approach also. So not necessary that we have to only stick on to only one approach. You can go for more than one approaches also and negate one approach. Maybe one approach may be much better with respect to, for example, environmental liabilities, environmental obligation, which will be the right approach. Cost approach will be better because you have to do the cleanup work. You have to do the cleanup and then hand over the green environment to the respective authority or to the agency, government agency. So therefore, cost approach. So even though market value you can take what is the income approach? What is income approach in environment obligation? You can negate it, but cost approach will be the best one there. So you have to come to a reason why you are taking that particular approach. It is necessary for the value. Necessary. Please look at this word. They are not use the word should, may, or must. Necessary. That means compulsory for the valuer to classify a method under one of the three approaches. The valuer should use judgment in making the determination, not necessarily rely on the classification below. So what are they? When selecting an approach and method, in addition to the requirement of this, the valuer must follow the requirement of 105 valuation approaches, including para 10.3. So what is 105 valuation approaches, para 10.3? Let me show you that. This is, please look at it. So this is 104 and I'm showing 105 para 10.3. This is the goal in selecting valuation approach and methods is to find the most appropriate method under the particular circumstances. No one method is suitable in every possible situation. The selection process should consider at a minimum the appropriate basis, respective strength and weakness of the possible valuation approaches, appropriateness of each method. This has to be discussed. This has to be derived and available relevant information. So all those things I'll put it and then only I will conclude. Yes, I will go for cost approach. That is most suitable here because reason number 1, 2, 3, 4. That is why I'm concluding cost approach is best. So like that you have to actually arrive at the conclusion. Good. Then market approach. So when I will use market approach? Under market approach, the value of a non-financial liability determined by reference to market activity. For example, transaction identical, similar non-financial liabilities. I told you this is the most difficult one. Finding a what do you call it as a comparable value. That too for a liability. Okay, and no two companies transaction will ever be same. And even though they are in the same homogeneous industry, taking one liability value of one particular company and then saying this is the value may not be possible, but you have to do a lot of adjustment. That is why they use a word called top-down approach. Please look at this. Transaction involving NFL frequently also include other assets, such as business combination that include tangible and intangible assets. So sometimes we have to actually do not only the valuation of NFL alone, but we have to do the valuation of all the assets, including NFL. For example, business combination. What do you mean by business combination? There is a merger, there is a takeover. So one power company is taken over by another power company. Now there should be a valuation should be done with respect to assets, with respect to liabilities, with respect to the environmental obligation also. There it comes as a package. So they will say, see that you have notices, possibility that the notice will actually crystallize into a liability you have to pay. So whatever consideration I will pay, I will subtract that probable. No. That case will not come. No. That is actually 120 crore. Don't subtract 120 crore. Oh, zyada hai. That will not happen at all. Then valuer will come. The valuer will come and he will say, yes, this is the probable liability. And how do you do that? I'm coming down, the top-down approach. Okay. And whatever valuation you do, everything is money. Everything is money with respect to business combinations. Okay. Transaction involving standalone non-financial liabilities, okay, are infrequent as compared to transaction with business and assets. Please look at this. This is transaction in NFL frequently will include other assets also with the combination. So that is why I said, along with when you do the due diligence, when you do the mergers, acquisition, takeover, at the time, they will say a list of 7 cases are pending. Possibly there is an obligation and you have sold this much. The warranty claim is still open. Possibly the warranty claim will come. So whenever this kind of reorganization happens, the consideration they'll arrive at subtract warranty claim obligation, subtract the environmental obligation, subtract the deferred revenue obligation with respect to contract revenues or receivables, subtract like that they will subtract it. Ultimately, sometimes you have to pay rather than he pays to you for selling your company. So therefore, that is why it is very normal in normal circumstances, and your role will be one among that valuation roles with respect to that entire business combination. Good. Now please look at this next one. While standalone transaction of only NFL alone, we do the valuation. When possibly in the AS purpose, financial reporting purpose, standalone NFL valuation is possible. It is there. And environmental obligation valuation. I'm taking only 1 or 2. I don't want to take more examples. And valuers should consider relevant market-based indication at that particular time. Okay. And how it is possible? That is the next thing. Although such market-based indication may not provide sufficient information with whom to apply the market approach, the use of market-based input should be maximized in the application of other approaches. A non-exhaustive list of market indications are here. What are they? Pricing from third parties to provide identical or similar products as the subject non-financial liability, deferred revenue. Okay. Then pricing for warranty policies issued by third parties for identical or similar obligation. So one by one he is giving example. Prescribed monetary conversion amount as published by participants in certain loyalty reward obligation. One by one example he is giving. What is the provide all these are published information. The traded price for CVR, contingent value right, with similarity to the subject non-financial liability. Example, contingent consideration. Whether such a traded price is there. So you have to actually find out, Google it, meet people, go to associations. They would have printed some rate card, some guideline method. Associations are there. In India, one good thing about India is you have so many associations, trade bodies, kirana merchants. For every associations, for every industry, you have an association. So that association, we have a lot of data. Please go there and get those data. That will actually be a lot of relevancy will be there with respect to valuation. Observed rate of return on investment funds, that return that invest in non-financial liabilities, especially litigation finance. Okay. So these are all some of the indications. But whether you will get these data may not be available in Google. Google and all came now only. But associations were there for a long time. They will be having that. For them, these data, they will actually keep it in shelf. For you, it is money. Go there, convince him. Data chahiye for research purpose, that purpose. Don't worry, I will also become a member of your association. Data mujhe chahiye. This is very important. Acknowledge them. Whenever you take that data, you acknowledge them in the, what do you call it as your report. This data is taken from so-and-so association because that is authenticated. That is authentic. Nobody can question because that is the real market data, association data. And you need to have good rapport with such association people, president, vice president, secretary, all those things. Call them, talk to them. You go and you present one paper before them, how valuation is important for their business. And then use social engineering and then only you have to take data. So mil julke you have to work, then only such market data will come. Otherwise, you have to bypass market approach, go to only cost approach. That's the only possibility. Good. Now, valuers must comply with para 20.2 and 20.3 of IFRS 105 valuation approaches methods when determining whether to apply the market approach to the valuation of non-financial liabilities. Those are the considerations. Then, the diverse nature of many NFL and the fact that NFL seldom transacts separately from other assets means that it is rarely possible to find market evidence involving similar non-financial liabilities. It is possible, not that it is not possible. You need to actually do some homework. Do that homework and find which place you can arrive. Sometimes the data, you need to actually pad up. That data will be some old data. You need to actually index it to the latest one so that sometimes all these data may not be in computer form. You take that data, you have your own blog, you have your own website, put all those data in that blog or website so that it will be useful for others to use that as a comparable. Then that becomes a standard, that rates becomes a standard. So this is how the comparables are developed. Okay. Good. Now please look at this. Where evidence of market price is available, valuer should consider adjustment. Very important point, guys. Now, how do you adjust? Discount it or premium it. Either discount it or premium to reflect those differences between subject non-financial liability and those involved in transaction. These adjustments are necessary to reflect the differentiating characters. So generally, if you have data about the warranty claim with respect to an automobile company, actually you need not go to that. The respective company itself can give. Environmental liabilities, you want to get data. Liquidated damages, you want to get data. That data you will get from the market. Now there, whatever data you have got, a lot of similarity will be there, dissimilarity will be there. Based on the dissimilarity, you have to discount it or you have to premium it. So with respect to that, premium is not overvaluing. It is actually a liability. So when you have to premium it, you have to pad it up. You have to be very careful. You are actually increasing your liability. Discounting is actually bringing down the valuation. No, you are bringing down your liability. That is actually a positive approach. Discounting is a positive thing. Adding premium is a negative thing in NFL valuation, unlike your asset valuation. However, the need for significant qualitative adjustments would indicate that another approach could be more appropriate for the valuation. Okay, that is called income approach. In certain circumstances, a valuer may rely on market price or evidence for an asset corresponding to the subject NFL. In such circumstance, the valuer should consider an entity's ability to transfer the subject NFL, whether the asset and related price of an asset reflect those same restrictions, and whether adjustment to reflect the restriction should be included. The valuer should take care to determine if the transfer restrictions are characteristic of subject NFL. Now, what do you mean by transfer restriction? This is actually discussed in the last two sections. Maybe we are now in 50.1. I'll show you the sections, the restrictions. Look at this restriction. Restrictions on transfer, 110. In 110, this restriction on transfer is again discussed. 50.9, from 50.9, we can again go there to 110. The value should take care to determine if the transfer restrictions are character of subject NFL. Example, an illiquid market. Restrictions that are characteristics of the entity. For example, financial distress. So then people may not be willing to actually buy out. So illiquid market, there may not be market at all. People may not be ready to buy. Can you take them the market data? Not possible. You have to discount it. So what do you call it as a discount for lack of marketability? That is the word we use actually in the valuation approaches and methods. So with respect to market approach, so that you can use it. That can be even premium discounted. I mean higher discount for lack of marketability. You can use. The comparable transaction method is generally the only market approach. Please, in market approach there are actually two methods they are given. They called as guideline transaction method, guideline publicly traded method. But guideline publicly traded method in NFL and all it is not there. So therefore, guideline publicly traded method is not taken at all. Only guideline transaction method. That means similar transaction, you have a data, take it, pad up and pad down. Okay, discounted or premium. That's the only method that can be applied to value non-financial items. Now, what are the market approach methods? In rare circumstances, a security sufficiently similar to subject NFL could be publicly traded, allowing the use of a guideline. So they're very rare. That is actually, they don't want to leave it, so they are giving that also. One example is contingent value rights that are tied to the performance of a particular product or technology. Now, what is called contingent value rights? Now, we have this carbon credit. What is called carbon credit? Carbon credit is the lesser the emission, you get the carbon credit, and carbon credit can be traded. Carbon credit can be traded. So now carbon credit has a value. I repeat, carbon credit has a value. Okay, so that means it is traded. So therefore, it is publicly traded. Now, you are an emission company. You don't have credit. You don't actually, not even your watered plant, leave alone, putting a seedling and then planting a tree. So therefore, not even a green approach you have done. So your company has only been destroying the environment. That means there is a question of carbon credit. But whatever carbon credit can earn revenue, that is a cost for you. Please remember. That's the reverse. That means that is the carbon debits you have actually done. So that is a damage you have done. So carbon credit as a revenue, that is minus you put it. Whatever carbon debits you multiply, you get the publicly traded value. So that is one approach you can adopt. Very interesting. So in rare circumstances, you can adopt that. Okay, but you need to get that carbon credit trading values. Now, what is the market approach methods? A method to value NFL under the market approach is often referred to as top-down approach. So in market approach, it is top-down. Income approach, it is bottom-up. Now, how would you do it? Good. In top-down approach, valuing NFL is based on the premise that reliable market-based indications of pricing are available for the performance application. This is a fundamental premise. Please be on. You have that step. First is purpose. Second is base. Third is premise. Fourth is approach. Fifth is methods. Now, purpose is clear. Base is clear. What is the premise? Very important. Premise means application. Okay. Under the top-down approach, valuing NFL is based on the premise, fundamental premise that reliable market-based indications are available for the performance obligation. That means you are doing for warranty claims, you are doing for power purchase agreements, you are doing with respect to what do you call it as the environmental obligations. You have some data available. Okay, so like that, like what you say, carbon credit data are available. Use that as a carbon credit. Carbon credit plus make that as minus. That becomes your cost. That is your actually market price. So therefore, market approach. So premise that reliable market-based indications are available for the performance obligation. So that is the premise. Yes, data are available. From where I took the data? Data I took it from India. Data I took it from Singapore. I took data from United States of America, Canada. There they are doing. There on New York Stock Exchange they do the trading of carbon credit. This is the price available. This is the data available. So from that data I'm taking. Now what is the emission measurement you have done? Who has done this emission measurement? Have you verified it? All those you put it and then you conclude that yes, this premise will be suitable, so I am taking this premise. A sufficient fulfilling the obligation to deliver the product or services associated with the NFL could theoretically price the liability. Okay, a participant fulfilling the obligation to deliver the product or service associated with the NFL could theoretically price the liability by deducting cost already incurred towards the fulfillment obligation plus the markup on the scores from the markup price of sale. This is the example for the top-down approach. Top, take the price, down, minus, theoretically price the liability by deducting down, top down, deducting already incurred cost towards fulfillment obligation plus the markup cost from the market price. This is called top-down. Now step by step they have given here. When market information is used to determine the value of subject NFL, discounting is typically not necessary because the effect of discounting are incorporated into market prices. Most probably, the discounting is not relevant because market price itself is the current price. So therefore, no need for arrive at the present value. Now, these are the steps, top-down approach. First, determine the market price. Second, determine the cost already incurred. So that is the assets utilized by the transferor. So the nature of such cost will differ depending on the subject NFL. For example, for deferred revenue, the cost will primarily consist of sales and marketing costs that have already been incurred in generating the NFL. Okay, so therefore, you would have already spent money to collect revenue. That revenue is not coming. So that is a cost incurred. So therefore, what is the market price of non-cash fulfillment? Minus whatever the cost that has been already incurred. So that will be the cost of, that will be the value of that particular non-financial liability. Determine the reasonable profit margin on the cost already incurred, not on the market price. The market price is already having that. On the cost you mark up. So because on the total market price, when you are deducting the cost, that is price, this is cost. So therefore, you are actually compare a 10 standard with a 7 standard. So what you should do, you should compare 10 standard with 10 standard only. So this cost also you should mark up with the margin and then you subtract your market price minus the market price of the cost incurred. Subtract cost incurred and profit from the market price. This cost incurred is marked up cost from the profit from the market price. So this is the top-down approach with respect to valuing the non-financial liabilities. Now income approach. Income approach is actually bottom-up approach. So cost, I'll go on add up. So what is the, actually what is the cost here means the income that is lost. Otherwise called the opportunity cost. The non-receipt of the income will be treated as an opportunity cost. So actually income approach is, income is lost. So therefore, the income is treated as an opportunity cost. So that you will actually add it up. That is what is called bottom up. Under the income approach, the value of an NFL is often determined by reference to the present value of the cost to fulfill the obligation plus the profit margin. We require to assume the liability. Now example. Now the primary method to to value the NFL is called bottom up approach. Now, how do you do the bottom up approach? Under the bottom up approach, the NFL, which may or may not include the overhead items, required to fulfill the performance obligation plus a reasonable markup of those costs discounted to present value over the period of years. So what are the key steps in bottom-up approach? Determine the cost required to fulfill the performance obligation, especially the, now we can take one example, what is called the warranty claim. Now warranty claim, you are today and for the next 3 years, warranty claim will come for the past 3 years sales. This year sale, next year claim will come. Last year sales, next year claim will come, which will be the second year claim. The previous 2 year sales, back sales, next year claim will come, that will be the last year claim. So look at this, whatever sales you have done the previous 3 years, next year claim will come. What is it? The 3 years back, whatever you made, the last year claim. 2 years back, whatever you made, the second year claim. The last year, what you made, the first year claim. Like that, the second year. Like that, the third year. So like that, you have to go and you will stop at one particular point and then you discount it to arrive at the present value. So whatever you have done so far, the past 3 years, the impact will be there for the next 3 years. The next 3 years, you have to arrive at the your obligation, and that obligation is at future value. Then you have to discount it. So that is why it is called bottom up. Okay, determine the cost required, and why it is called bottom up means that particular obligation will be at cost price. Arrive at the present value, and then up. What will you have? You add the markup. You add the profit margin on it. Why profit margin you are adding up? Because that is the profit which has been foregone. Profit which has been foregone. That is why it is a cost. All this you have to explain. Why did you do this? Why did you add it up? Why you are adding? Why you are adding? Because it is an opportunity cost. By installing this in my warranty claim, I am actually losing my profit. So therefore it is a cost to me. So therefore I am adding it up. So all this have to be explained. So your valuation report itself equivalent to converting the practical aspects of your NFL, your IVS 220. Whatever IVS 220 says, it has to be brought into your valuation report. Determine the cost required to fulfill the performance obligation. We have the last 15 minutes. I will complete it in another 5 to 10 minutes, and after that, I'll invite questions from all of you. Okay. So good, guys. Such costs will include direct cost to fulfill the performance obligation, but may also include indirect costs, such as charges for the use of contributory assets. The very, what do you call it as the term exclusive only for valuer. Only valuer to valuer, they will understand what you mean by contributory asset charge. This contributory asset charge with respect to NFL will include fulfillment cost, represent those costs that are related to fulfilling the performance obligation that generates the NFL. Cost incurred as part of the selling activities before the acquisition date should be excluded from the fulfillment effort. So now what is contributory assets? But may also include the indirect costs such as charges for use of contributory assets. Now what are contributory assets? Fixed assets plus working capital. Fixed assets plus working capital, on that a particular charge, 5%, 10%, 18%, 8%, multiply and add up to that cost. So therefore, because your warranty obligation, there may involve people, efforts, and your infrastructure. All those are involved with respect. It is not the cost alone you take from the shelf and then put it. There are people involved. There are time involved. There is a booking you have to do, waiting, then delivery. So all this involve time, your effort. That particular time, if at all I have used it for my other purpose, I would have earned revenue. Therefore, it is a cost. So that warranty claim, to fulfill that warranty claim, there is a contributory asset charge. That contributory asset charge have to be quantified. That also is a cost. Very interesting valuation. So what is contributory asset charge? They are saying, explaining here. Contributory asset charge should be included in the fulfillment cost. But fulfillment, what is fulfillment? It is not that somebody comes, Sumit is sold, Sumit is actually repaired. He comes, okay, that particular, it is not that in 1 minute, okay, just like that, okay, replace. No, it is not. You take it, book it, you need people, you have to inventorize it, you have to send it to the people, that those guys have to be there. You say 3 days later you come, till that you have to keep it in your shelves, your self rental cost, and then your serviceman's salary, proportionate salary. So all these are fulfillment costs. So it is not that only replacement of that particular component cost alone. The result is called contributory asset charge. So in limited instances, in addition to direct and indirect cost, it may be appropriate to include opportunity cost. That's what I already told you. The profit. Okay, good. Then determine the reasonable markup. So to find the fulfillment effort, in most cases, it may be appropriate to include an assumed profit margin on certain cost, which can be expressed as a target profit, either a lump sum or a percentage return on cost or value. An initial starting point may be to utilize the operating profit of the entity holding the subject non-financial liability. However, this method assumes profit margin would be proportionate to the cost incurred. In many circumstances, that there is rational to assume profit margin, which are not proportional to cost. In such cases, the risk assumes value added or intangibles contributed to the fulfillment are not the same as those contributed pre-measurement date. When costs are deprived from actual, quoted or estimated prices by third-party suppliers, this cost will directly already include a third party's desired level of profit. So a reasonable markup, all these factors have to be considered. Determine the timing of fulfillment. And that is what I told you. If you are having a 3 years sales, 3 years warranty, 5 years warranty you are given. 5 years you have to go front, and what is the possibility of your past years turnover will have a future obligation based on the probability of your past 5 year or 10 year, based on your sales, what is the warranty claim that has come. Take that probability, take that actuals, take that proportion. What is the actual to the total sales made? What is the proportion? Use that proportion in every year, and then arrive at the what is the warranty claim that will come, and multiply with the cost, and then add the markup. So and add the contributory asset charge. Then arrive at the value. That value you have to discount it. So this is how the calculation will happen. So it's a very big calculation. So warranty claim today it has been only done by the what do you call this the respective company, and who actually verifies it? Nobody. It's only the auditors, the respective auditors will verify the calculation. And when you ask any auditors, they will say, last year it was done like this, so we have the same has been followed. Consistency. They use a word called consistency. So based on consistency, it has been done. But this is the place where valuers have to come forward, and you have to actually pad for these kind of opportunities, and RBOs have to actually make sure these opportunities are knocked properly. And today you have got a standard itself. What is the fun in having a standard without having a work? So therefore, who will actually create this work? It is not that when you sit quiet and your office work will come. You have to actually create the work by making RVOs to work and also IBBI to work accordingly. And through that, MCA also should work. MCA should come out with a direction that India's valuation with respect to NFL, non-financial liability, has to be, you know one thing, CARO, Companies Audit Report Order, CARO, Companies Audit Report Order 2020. Please go and download it. Property, plant and equipment, the valuation, revaluation has to be done only by a registered valuer. It has come. MCA has given a direction, notification. Why don't you actually ask MCA to actually give a notification? That I am actually very sorry to say in this particular forum, there are many people who actually have a negative aversion, negative point with respect to the valuers bill, which is not required at all. Valuers bill is going to actually throw open a lot of opportunities. If you read it properly, it is going to actually throw open a lot of opportunities. And the what do you call this? People have a reservation with respect to various aspects, including the Schedule 1, Schedule 2, and with respect to the reprimanding and the penalty clause. My view is penalty is very less. They should even increase the penalty. When all of you are ready to follow the best practices, all of you are ready to follow the best standards, why they need to actually worry about the penalty clause? Definitely no. You know who will worry about it? Those who are lethargy, those who don't want to, those who want to value left and right, those who don't want to study standards at all, those who don't want to actually do a quality work, they only will worry about that. We need not worry. We are actually 78 participants here. We need not worry about it because we are studying standards. We know what it is. We know how to apply it. So we need not worry about it. The future is very, very bright for the entire valuation profession. So the discount rate should account for the time value of money and non-performance risk also. Typically, it is preferred to reflect the impact of uncertainties such as changes in anticipated fulfillment cost. And remember this sentence very carefully, guys. Valuers are not calculators. Valuers are values. There is a value addition you make with respect to a report. You don't calculate. Further calculators are there. Further softwares are good. And when fulfillment costs are derived through the percent of revenue, valuer should consider whether the fulfillment costs already implicitly include the impact of discounting. For example, prepayment of services may result in a discount, as one may expect to pay less for the same service as compared without paying through the contract term. So that is with respect to this. Cost approach is very, very simple. As limited application for NFL, as participants typically expect a return on fulfillment effort. But as I told you, you can also use cost approach. Okay. So they have made it very clear. IVS very typically says as limited application. But my view is your environment obligation, there is one approach in which environment obligation can be valued. It's called cost approach, where the cost incurred to bring back the environment to the original shape and original greenery. So there you can use a cost approach. So this is one place where the RVO can think and come out with a guidance with respect to cost approach. Special consideration, discount rate, estimating cash flow, restriction on transfer, taxes. These are all the areas. There are some additional points that has been given. How you can actually use those factors to actually bring your valuation to a reality. For example, discount rates. The fundamental basis for the income approach is that investor expect to receive a return on their investment should reflect the perceived level of risk. So the discount rate should account for the both the time value of money and non-performance risk. Both you have to actually bring the discount rate. So therefore, a discount rate can be higher also. So you can say for time value of money, it is 12%. For non-performance risk, I am adding another 5%. So therefore, totally 17% is the discount rate. You can do it. So non-performance risk typically function of counterparty risk. So that is where it is. For example, there are some obligations which that party has to perform. Then only you can actually perform your role. Otherwise, you can't perform it. So that will actually be an impediment for you, or sometimes you have to do that also. So that is called the counterparty risk. Now I'll take you to one more last one. This is estimating cash flows. This is one part I want to say, especially at 100.2. How do you estimate cash flows? The non-financial liability, they say you can estimate cash flow using scenario-based method. So worst case scenario, best case scenario, optimum scenario. 3 scenarios you can have. You can have 4 scenarios. You can have 5 scenarios. And give weightage, probability to each scenario, and then arrive at the weighted average. Best method. So I think with this, I will leave the floor open for all of you to share your queries, if any. And with respect to taxes, you have to consider the tax benefits also. And will you consider pre-tax or post-tax? You will consider only pre-tax cash flows and pre-tax discount rate. But post-tax cash flows also can be considered. Then your discount rate also should be post-tax. So both they are giving. So it is not that pre-tax cash flows only has to be considered. But generally, valuers should consider only pre-tax. But in certain circumstances, it may also consider post-tax. Then your discount rate also should be post-tax. So these are all some considerations which they give. So guys, last but not the least, this one point I want to share with you, because this is post-COVID pointer. In post-COVID, possibly this force majeure clause can be implemented by the contractors, where impossibility of event, because of the delay, their payment would have been held stuck, and only if that payment is received, they can actually churn it out. So they will say impossible to actually complete it. So I am surrendering the work. So we make the rest of the payment. Now here, there is a possibility of the non-financial liability. So for example, whether the respective party can deduct the charges with respect to liquidated damages, number one, for the non-performance or delay. Number two, whether the delay in, for example, you have filed, you have informed the particular contractee that I am invoking force majeure clause, I am withdrawing from this particular assignment. Whatever is the work that has been done, I have measured it and I have submitted the bill. Please settle it. So, what will be the implication? Will the bill will be settled, and if can the other party can accept it? If the other party accepts it, will the payment will be released immediately? The payment is not released immediately. If there is a delay, and what is a probable delay that is possible based on the communication without any arbitration, and if there is a probable delay, there is a deferred revenue, what is the cost that will be incurred with respect to the company, and how that has to be measured and valued as part of the, because on the receivable this will be a cost, so that will be a net revenue, that will be a net revenue technically speaking. So therefore that has to be measured and it has to be valued and it has to be recognized in your books of account, because that has an impact on your profitability. So force majeure clause will throw open lot of work, and this is a place where you must make a request to all the RBOs to have a lot of sessions. What is force majeure clause? What is the impact force majeure clause will have on contracts, on construction contracts, on what you call it as your turnkey contracts. Turnkey contracts includes construction and erection of machineries. So what will happen? Part is performed, part is not performed, and whether I will post pandemic, I'll try to complete to one extent of the contract and then I'll exit it. Is it possible? It is. Then whether without arbitration can I make the claim? So all these are going to be very interesting, and valuers are going to have a lot of work with respect to implementation of this force majeure clause. And please make sure that legally you understand what force majeure clause is all about. Force majeure means an event or effect that can neither be anticipated nor controlled. COVID-19 is one such event. The term includes both acts of nature and acts of people. And what are the prerequisites to invoke force majeure? Parties must have a valid contract. It will be there. Contract is yet to be performed. One part is performed, one part is not performed. It can be 40, 60, 20, 80, 25, 75, whatever it can. Force majeure event should have been an unforeseen event. COVID-19 is like that. Now there are two things here. Please look at this. The force majeure clause is there, force majeure clause is not there. If force majeure clause is there, it can be invoked. If force majeure clause is not there, Section 56 of the Indian Contract Act says, after analyzing if force majeure event had direct impact, then even then you can apply force majeure, which is called as an implied force majeure. There is a possibility an implied force majeure clause to be analyzed on circumstances of the case based on, okay, there is impossibility of event. Okay, when there is a event itself is impossible, there is possibility of event is that, then can you do it? No, you can't do it. Impossibility of event. What is impossibility of event? Because of the contract itself will have a very stiff clause that you have to complete it within 3 months time. Now lockdown, where will you do it? So it is impossibility of event. That is why government, all government contracts like in Atmanirbhar Bharat Abhiyan, they made it very clear. All the contracts by default, it will be extended 6 months. By default. So one government order, GO, they made this. So you can actually, you cannot imply FM clause there. So, but if FM clause is there, you can implement it. How? Have listed a specific FM clause. If it is being mentioned, then you have to go through that clauses whether COVID-19 forms part of it. Now there can be broad interpretation of FM clause to assess if event and contract can draw inference of force majeure. So therefore, a legal aspect is there with respect to implementation. Post to that, the valuation work will come, because there is an impact on liability and on valuation and on receivable. The receivable will come down. Why come down? Because there is a liability from your side. So what is that? This is the place where there will be a dispute between you and maybe between the contractor and the contractee. Maybe you may be a valuer as part of the contractee, or you may be valuer as part of the contractor, or two valuers will be appointed, one for the contractor, one for the contractee. do the valuation and give what is the debit I have to subtract from the respective bill amount. So these are all very interesting aspect, guys, in the days to come. In another few more months, all this work will be crystallized. Okay. So this is how you will invoke the force majeure clause, whether on termination, suspension, alteration, negotiation. Force majeure clause not applicable means then how you can do it. So this will actually take a very, very important aspect, because of this you may get a non-financial liability, and non-financial liabilities always, it can be liquidated damage, it can be deduction from your revenue, or it can be a penalty, or it can be the damages which you have created during the course, the damages which you have impacted to them because of the delay or non-performance. Many things will come. So that is why deferred revenue. So all these are your contract obligations, non-performance obligations. So all these possibilities are there. I must thank each and every one of you for being very, very, very patient. Okay, this is a very, very driest subject, but I'm sure I have made this subject to the extent possible comfortable to all of you, and I'll be open for some questions.
Thank you, Raju sir, for this elaborative session. We will just change the chat setting. Yeah, if anyone has any queries, please write it down in the chat box.
Yeah, we have a lot of friends. Shushant Agarwal, Ani Vijayan, Engineer Ramesh Karle, Kunal ji, Atul Kumar ji, Umakant Verma, Shantanu ji, Makarand Rajendra, Nitish Grover, Sunil Raut, Sanket Nayak, Nand Kishore Bharadwaj, Harikrishan Narangs, Pratap Surya, Kunal Kalantri, Madhavi, N.V. Subbarao, Rajkumar, Mr. Saurabh Barik, Amit Goyal ji, P.K. Gaur, Mr. Sunil, Pradeep Kotte, Sudhakar Rao Dunga, Pawan Mohata, Mumadi Obula Reddy, Ashok Punshi ji, Abhijit Paranjab ji, Madhubala Nagaraju ji, Ganga Agarwal, Shashank, Radha Krishna Reddy, Arvind Konar, Naveen Chandra Kalaria, Princey Vijay Kumar, Gurunath Kulkarni, Ramesh Kumar, and Mr. Vinay Ramachandran. Saurabh, how are you, Saurabh? Nirav Manier, good. Mr.
I will
Sarat.
type the queries, sir. They are typing in the private chat. I will just type it for everyone.
Oh yeah, we have tons of questions. Very good, very good. So whether non-financial valuation will take place after the bill is passed? Oh, definitely, it is already there. In DCF method, why cash and cash equivalent do not form part of working capital? In DCF method, why cash and cash equivalent do not form part of working capital? No, we actually take the increase in working capital, because cash and cash equivalent will form part of your cash from operations. In calculating free cash flow from equity or free cash flow from what do you call it as firm, we arrive at cash. There is a method called from CFO you can arrive at FCFO. So there we are taking the increase, what do we call it as, because it's a going concern, we'll only take the investment in working capital. So that's why. In case of calculating, can we have profit added in cost approach? Actually, no, you cannot do that. In case of calculating liability for ENV penalties, NGT guidelines are to be considered or not? Yes, absolutely. That is why what you call it as the standard itself says the relevant guidelines, wherever it is the law, case laws, please you have to follow. When individual valuer will get work on, you will not get, sir. You work will actually come to you. You have to through RVOs and through the what you call it as forums. You have to make the corporates understand the registered valuers are the right people to do the valuation of NFL. Then the concept is explained so nicely. In fact, I need to do further study. Highly obliged if you can share any such report without giving name of client. Okay. Then while doing product costing, NFL portion is included. A portion. Yes, you are right. You have to do it. Absolutely. So very good point been brought out. I think thank you very much. May I request the organizer to kindly sum up the proceedings and conclude. In DCF method, as we have taken change in working capital, but cash and cash equivalent are ignored. Naturally, cash and cash equivalent will only be considered to arrive at, to net it off. For example, what is the value of the firm? At the end, you will add this cash and cash equivalent minus the outstanding debt. I repeat, Mr. Amit Goyal, cash and cash equivalent, we will add it to your present value because cash and cash equivalent is in present value terms. So future FCFE or FCFF, you discount it, add the cash and cash equivalent, net to the outstanding debt. That is why we don't ignore it, we take it. So thank you. I will hand it over the session to.
Thank you, Raju sir, for this detailed explanation. I thank you on behalf of our whole team. And thank you all the professional delegates for being part of this session. And we will share all the remaining things, whichever is